of shares outstanding before the event for the proportional change in the number of shares occurred which were issued in the beginning. One of the first rules that we need to remind ourselves for is that we have to recalculate or we have to regulate the number of shares. We calculate what we know as a bonus that helps us not only to correctly calculate the number of average shares for the previous period, but also to be able to restate the amount of the earning per share for the previous period. So what is the bonus factor or the bonus fraction? Actually, this is the ratio between the number of shares after the bonus issue to the number of shares prior or before to the bonus issue. So this is how we calculate the bonus factor, actually. The number of shares after the bonus issue, the ratio to the number of shares prior to the bonus issue. In our case, in our example, the bonus factor will be equal to 6 to 5. Remember that the terms of issuing the bonus was 1 new share for each 5 existing. That is, prior to the bonus issue, we would have 5 shares, and then after that, 1 more. So it is 6 to 5. I don't know if that is clear enough, or we need to also explain that. I hope that is simple to understand in this case. And then the third rule that we have to keep in mind, this bonus factor is used for 2 purposes, I would say. So the bonus factor that we calculate, 6 to 5, is used for 2 purposes. The first purpose is that we need that to restate or to calculate the weighted average number of shares for the current year. How we do that? Usually we time weight the number of shares to take into account the moment when we issue new shares, if they are shares issued at the full market price. But in case they are bonuses, that is, they are issued at no consideration at all, that is that we need to take into account the time when they are issued, but also the bonus factor, which takes us to the beginning of the current period. So we need the bonus factor to calculate the weighted average number of shares for the current year. That means in our mind, we are going back at the January 1st of the current period. Okay? And secondly, we use the inverse of the bonus factor is used to restate the earnings per share figure of the previous year. So this is how we use the bonus factor and why it is important to calculate that as a second rule over here, and then to be able to use that during the calculations later. So first, the bonus factor is used to weight the number of shares, and basically this is done to fulfill the requirement of IS 33 to consider as if the bonus was issued not in 1st of July, but since the beginning of the current period. And secondly, by using the inverse of the bonus fraction, we can restate the earning per share figure of the previous year, very simply. So how to solve this example right now? So we'll use this sheet over here to represent the solution of our example. In order to have it more easy, what I will do is that I will copy the data, so the information about the earnings and number of shares by the end of the year, I'm just going to copy that there, so we will have this information readily available over here. And then we will start to calculate what we are required for. So the first thing is that I need to calculate earnings per share for 2018. This is the first requirement of this example. Remember that the earnings per share is a ratio between the amount of the earnings and the weighted average number of shares in issue. So earnings per share is equal to earnings that are attributable, as we said, to the common shareholders. I'm not putting that in very big words. It's just a small title over there, earnings amount. That is to be calculated with a weighted average number of shares for 2018. Okay, that is the formula that we have here. And we need to take into account the weighted average number. If I just base my calculations on 1,200,000 shares over here, I'm not quite correct because these shares belong to 31st of December. So 2018 basically starts with 1 million and we are ending with 1,200,000. Why? Because remember, somewhere in the middle of 2018, we issued a bonus which was 1 new share for each 5 existing, and that increased the number of shares by 200,000. And if we see the ratio by the end of the year, it is actually 6 to 5. 1,200,000 divided by 1 million, it is actually 6 to 5. So we need to calculate in this moment what is the weighted average number of shares for 2018. In order to do that, I'm just going to prepare like a simple table that will facilitate our calculations having the Excel tool over here. So for the basic earning per share in 2018, first of all, I'm going to write the earnings amount, and then I'm going to calculate the weighted average shares for 2018. The ratio equals the earnings per share. So the ratio between them is going to be easy to calculate. So the amount of earnings in 2018 is 550,000. What about the weighted average number of shares? Remember that I need to take into account the period or the time when they were issued, and then to apply also the bonus factor on this amount of shares. So I'm going to represent the calculations over here. So let's say that we start with 1 million shares. They have been in issue like 6 months out of 12 months. We start in 1st of January with 1 million shares. We have them in issue for 6 months until 1st of July when we issue the bonus. So we have to weight them with 6 to 12. But also remember that we have kept this number of shares before the bonus issue, and we have to apply the bonus factor to this amount of shares. So we multiply that with 6 to 5. So we apply the bonus factor to the opening number of outstanding shares. Plus, on the other hand, 1,200,000 shares that we have in issue for 6 to 12. That is, we also apply a weighted factor to the closing number of shares, but we have them in issue only for half the other year. In case we perform the calculations following this formula over here, we'll have the amount of shares equal to 1,200. Sorry, 1,200,000. The weighted average shares calculated. Elisa has a question in the chat. Thank you for asking whenever there is something not clear. If you make the calculations over here, 1 million multiplied by 6 to 12 and then multiplied by 6 to 5, which is the bonus fraction, will give you, it's equal with, so the first part of the equation here, will be equal with 600,000. Okay, just try that and you will have that amount of shares. And then the second part of the equation over here will also give you 600,000. Again, we are having 1,200,000 outstanding, weighted average number of outstanding shares, simply because we are applying the bonus factor over here. This is the crucial point, the crucial element of doing the calculations. Do not change anything in what you are doing. Maybe you are keeping notes in your notebook. I will just mention something over here. Just assume that maybe we are not having a bonus issue, but just assume we are having an issue of shares at full market price for the moment. So again, assume this is not a bonus issue. Assume this is an issue of shares with the normal price in the market. In this case, you have no bonus fraction. Okay, so you just issued in 1st of July 200,000 new shares at market price. That is not a bonus. Therefore, there is no bonus fraction, no bonus factor over here. In this case, the number of shares, weighted average shares, according to the IS 33 rules, would be equal to 1 million multiplied by the period of time they have been outstanding. That is, for 6 months, I used to have 1 million shares outstanding. Then, for the next 6 months of the year, when I issued 200,000 new shares, I will have 1,200,000 shares for 6 months. If we make the calculations over here, as you can see, the first part of the equation will be 500,000 plus 600. I would have 1,100,000 shares in issue. Again, if that is not a bonus issue, if that is an issue of outstanding common shares with full market price, that is an ordinary share or issue of shares like every time, we would have the weighted average shares number 1,100,000. But actually, this is not an issue of common ordinary shares. This is a bonus issue. We have issued shares with no consideration. That is, we are increasing the number of shares, but we are not having any resources coming into the company. Therefore, I need to take into consideration as if the bonus issue has been since in the beginning of the period. Why does IS 33 actually requires that to have a retrospective effect? That is to protect the position of the current shareholders. These current shareholders are the ones that are going to receive the bonus. So they have been probably in the company since the beginning of the period, and therefore it's quite right for them to have this weighted number of shares and bonuses considering as happening since the beginning of the period. It's the same shareholders that are receiving the bonus, and that is that we will assume this is happening not in 1st of July, but in 1st of January. It is a transaction happening or related to the existing shareholders. I don't know if that is more clear now, Elisa. Actually, this is the calculations and the data if we would have a normal issue of shares, but actually this is a bonus issue, and that is that instead of applying only the time period to the opening amount of shares, we also need to apply the bonus factor to that. That is 6 to 5. So just remember to add or to weight the opening number of shares, not only with the time period, but also with the bonus fraction. Why? Because I need to take this transaction back in time since the beginning of the period. So the amount of shares that I find at the beginning of period, I would just take them and weight them to the bonus fraction. And if we apply actually the bonus fraction, the first part of the formula, it's going to bring or to result in an amount of shares, not 500,000, but 600,000. And that means that the total amount of weighted average shares to be used in the calculations of the earnings amount will be 1,200,000. Any questions so far? Is it clear for everybody? Maybe it's clear now for Elisa, but probably the others may have also questions. Any question? Okay, maybe it's more clear now. So again, you have to apply, remember the rules over here, you have to apply the bonus factor to calculate properly and correctly the number of the weighted average shares for the current year. Again, why? Because IS 33 requires us to consider the bonus issue as not happening actually in 1st of July or in 1st of September. It can happen whenever it wants to happen during the year. Whenever it happens, I will take it back to 1st of January. And not only in 2018, but as we'll see later, we have to restate 2017 as well. Okay? So this is why we apply this bonus factor over here. So we can have, I'm just increasing the figure to be more clear. So we can have the correct number of weighted average shares. So this is equal, after we correctly calculate the earnings per the number of weighted average shares, this is equal with the basic earnings per share of 2018. Again, this is the ratio between the amount of the earnings and the number of shares. In case we can have like a common explanation over here. Probably the basic earnings per share for 2018 is like 45.8 cents per share. If we can express the amount of earnings per share as it is required. Remember that it is expressed, okay? It is expressed as cents or dollars or euro or another monetary unit to each of the shares. Okay, so let's have this as a simple table that we can use for further calculations as well. Remember, you can use this also later in calculating earnings per share, being them basic or diluted. Again, it's a simple table that calculates the two components of the ratio. The numerator is the earnings amount, and the denominator is the weighted average number of shares. Now, the second requirement of this exercise is to calculate the basic earnings per share for 2017. There is a very simple way to do this. First, I can follow the path that I calculate, or I take the amount of the earnings per share calculated and stated for 2017, and then I apply the inverse of the bonus factor to restate that amount. So again, to calculate the basic earnings per share for 2017, I will follow the same approach. I will compare earnings to the weighted average number of shares. Again, this belongs to the previous year. So we are referring to earnings for 2017 and weighted average number of shares of 2017. What is the amount of earnings in the previous year? Now, refer to the existing information that we have. It's 460,000. What is the weighted average number of shares in 2017? You see that we are completing, or we are ending 2017 with 1 million shares over here. And during 2017, no change in the number of shares. So this is one of the easiest situations it can be. The weighted the weighted average number of shares for 2017, it's simply 1 million shares. So again, we start and we end 2017 with 1 million shares, no change to that amount. And that is one of the most simple situation it can be. Again, basic earning per share for year 2017, it will simply be the ratio between earnings and the weighted average number of shares. That is the amount of the basic earning per share as we stated at the end of 2017. We completed the financial statement and we reported the financial statement stating or declaring a basic earnings per share value equal to 46,000. So that is over here 46 cents per share. Now at the end of 2018, we need to restate the basic earning per share of 2017. Again, why? Why do we do that? Okay. IAS 33 requires that if we issue a bonus, as we did during 2018, we apply that retrospectively. That is, we take it back in time to the earliest period that we are reporting. Remember that we usually, when we report the financial statements for 2018, we will also state the amounts for the previous year, that is 2017. But now, when we state the amounts for 2017, we will not report the basic earning per share like this anymore. So it will be a different amount than before. It will not be 46 cents per share, but it will be equal to basic earning per share for 2017 restated at the end of 2018 will be equal to the basic earnings per share as declared or stated in 2017 multiplied by inverse of bonus fraction. You can have that, for example, as a formula, and you can keep that in your mind as a common rule to apply. Again, the basic earning per share of the previous year restated at the end of the current year will be the figure that we calculated previously multiplied with the inverse of bonus fraction. That is 46 cents per share will be multiplied with the inverse bonus fraction, that is 5 to 6. The bonus fraction itself is 6 to 5. The inverse is the what we have as a denominator will become the numerator of the ratio and so on. So the inverse of the bonus fraction is 5 to 6. And this will give us a new amount of earnings per share to be restated for 2017, 38.3 cents per share. What do you notice about the restated amount of basic earnings per share for 2017? If I was to ask you in this moment, we have restated the amount of earnings per share for 2017, and you see that it is lower than the amount originally reported in 2017. In 2017, we reported 46 cents per share. Right now, we are reporting only 38.3 cents per share. That is that the issue of a bonus in 2018 affects as well the numbers that are previously reported to being a higher amount or as higher figures. Any question to that? So the bonus treatment, how the IAS 33 requires the bonus to be calculated and reported. Remember, something very useful to do is to calculate the bonus fraction. The bonus fraction is really very easy compared to the rights fraction that we'll explain later. The bonus factor is simply the ratio between the number of shares prior with the number of shares after. Sorry, I'm just making some corrections over here. And then we use that for two purposes. First, to calculate a correct number of shares, weighted number of shares for the current year, and then the inverse of the bonus fraction to restate the amount of the earnings per share for the previous year. So this is what we have stated in 2017, but having or taking into account that we issued a bonus during 2018, this will also affect the figures or the amounts for the previous year. Any question to that? Something that we need to clarify? Something that we need to explain more? Okay. I think there is no question. I hope that is clear. So we are continuing with our next example. This was the example of a bonus issue. I acknowledge that maybe it's not very difficult, it's easy. Right now we'll have the example of how to treat the rights issue. So in case we have issued some rights, how will that affect the calculations of earnings per share in the current year and in the previous year? Remember that the rights issue is somewhat a mixture between a normal issue of shares at full market price and a bonus issue. That is because you are issuing shares at a price below the market price. So that is something in between a bonus, simply issuing shares for free, not applying any charge or any price to them, and issuing shares for full price in the market. So let's have the basic information about this example over here. We have an entity that has issued one new share for every two existing shares. And the price that is applied over here is $1.5 per share on 1st of July 2018. Actually, the pre-issue market price was $3. That means that when we issue these rights, it is issued at a market price lower than the original normal price of other shares. So again, we know that this is a right issue when we issue some new shares to existing shareholders. For existing shares, as we can see, there are 1 for 2 each existing share, but we apply a price that is lower than the normal price. We have some information that are relevant and necessary for 2 years. The profit that is available to the ordinary shareholders for the year ending on 31st of December is basically what you can see here for each of the year. And then we have the number of ordinary shares in issue at the end of the year. It is 800,000 in 2017, and then it becomes 1,200,000. We can see that the change in number of shares from 2017 to 2018 is an increase of 400,000. That corresponds to the issue of rights over here. Remember that we issue one new share for each two existing. That means that if we start 2017 with 800,000 and we issue one for each two existing, we will increase the number in the shares with 400. And that really fits and complements all the scenario over here. We start with 800,000, we issue 400,000 to comply with the rule one new share for each two existing, and we finish 2018 with 1,200,000 shares. The requirements are the same as in the previous exercise. Calculate the basic earning per share for 2018 and then restate the prior year figure for 2017 as we would state them, as we would report them in the financial statements for the current year, for the year ended in 2018. I will use the same approach. First of all, we are going to state some rules, what to do in case of rights issue, some formula that we need, and then we are jumping to the how to solve this example. So about the rights issue, which are the rules that probably it's good for us to follow. Remember, a rights issue combines the features of an bonus issue and a full market price share issue. So they combine both features, as we can see here, and therefore we have to take into account several things. The second thing that I need to take into account is that the number of ordinary shares to be used in calculating basic earning per share, basic earning per share for the period before the rights issue is the number of shares outstanding before the issue multiplied by right now the rights issue is known as multiplying factor. We had the bonus factor at the bonus issue. At the rights issue, we know that as a multiplying factor. Now, what is the multiplying factor? Remember that the multiplying factor, as we explained during our lecture on Friday, it's not the ratio between number of shares, but this time is the ratio between share prices. So that is price of share prior or before to issue divided with what we knew as price of share after the issue, but not the market price, but what we denoted as the theoretical X rights issue. Theoretical X or after rights issue. So again, the multiplying factor that we use to facilitate all the calculation is not a ratio between number of shares like in the bonus issue, but it's the ratio between prices. The prices of share prior to issue and this theoretical X rights issue price. Now, what is this theoretical X rights issue price? This is a thing that is special to the case of issuing rights. And I'm writing the formula over here. Theoretical X rights issue price will be equal to the ratio between the total value after the rights issue to the total number of shares after the rights issue. That is, the theoretical X rights issue price will be like an assumed price that would be right to be followed and to be reflected by the market if the market would be really very consistent at following the number of consideration and number of the shares that are being declared by the company. As we said, usually what happens is that the market itself does not reflect everything that the company is doing, and the market will have its own price after the rights issue. Right now, we want to know what would be a correct price of the shares to reflect for the issue. Therefore, we calculate the theoretical X rights issue price as the ratio between how much money do we have after issuing these rights. That is the total market capitalization value before the issue plus the proceeds from the issue of rights. The total of this sum is divided with total number of shares after the issue. Okay, that is a somewhat long formula over here. Let's have it all on the screen. So this is like a fair representation of what we do to calculate the theoretical X rights issue price. Again, it's some assumed price. It's not something that the market actually will reflect. But this theoretical X rights issue price will divide together the total value of my shares, that is, how much the shares were worth before the issue. Total market capitalization before the issue is equal with the number of shares before the issue multiplied with the price in the market, plus proceeds from the issue itself, rights issue. Proceeds from the rights issue will be simply the product between the number of the shares that are issued through the right to the lower price with which they are issued in the market. And then the total sum is divided with the total number of shares after the issue. Now, let's keep this in mind as common formulas that we will apply later during the solution. But just for the moment, let's have this rule over here. Okay, the third thing is that after we calculate the theoretical X rights issue price and the multiplying factor, what we use that for? The multiplying factor, this multiplying factor is going to be used for two purposes. This is exactly the same thing as in the case of the bonus issue. The multiplying factor first will be used to correctly calculate the weighted average number of shares for the current year. And the second purpose why we need the multiplying factor is to restate the basic earning per share for the previous year. And actually, the inverse of the multiplying factor will be used to restate the basic earning per share for the previous year. So this is how we use the multiplying factor for the two purposes, and this is actually the same use that we do also to the bonus factor. Okay, so let's see how we can use the formulas over here to solve this example. First of all, I'm taking the relevant information over here and I'm copying to the solution page, so it will be easier for us to follow the data and all the information needed. So we are referring to this information over here, and something else that I'm also doing is that I'm taking into account the two formulas that I need before I apply these formulas for the calculations that are needed. So first of all, we need to calculate a multiplying factor, but in order to calculate the multiplying factor, I need to first calculate the theoretical X price. So let's start with the calculations of the theoretical X price issue. Okay, so in our example, how would the calculation of the X rights issue price would look? If we follow the formula over here, it should not be difficult. Just follow what I'm going to put as data, and in case you don't understand, please ask. I apologize for the grammar. I apologize because I'm trying to be fast here. It's probably some spelling mistakes, but it's okay. So in our example, what are the values that I'm going to take into consideration? The total market capitalization value before the issue, that is how much our shares are worth in the market. Remember that before issuing the rights by mid of 2018, we have 800,000 shares in the market, and each of them was priced at $3 each. So the total market capitalization value, it is 2,400,000. So again, the total market value is the product between the number of shares before the issue and the market price before the issue. Both of them, as you can see from the data over here, number of shares before the issue, rights issue is 800,000, and the market price is $3 per share. Okay, so this is the market value. We add to this amount the proceeds from the issue. What is the amount of money that we are taking in the company because we are issuing some rights? Remember that the number of rights that we are issuing is 400,000 new shares that are rights, actually, share rights, because it was one for two each existing issue. And each of them is issued at a lower than market price. Remember that was $1.5 each. So the total represents right now what is the value or how much the shares of the company are worth after the rights issue. So first of all, this is the total market value before the transaction, before issuing the rights. Except for the total market value, I'm getting in some more money. I'm issuing 400,000 shares, each of them by $1.5 each. Now, all this value, all this worth, I'm going to divide with the total number of shares after the issue. Now, remember that before the issue, there were 800,000 shares plus 400,000 that represent the number of the rights issue. So it is actually 1,200,000. If we are really correct to our calculation, we will have a price of $2.5 per share. So in our example, the theoretical X price issue is $2.5 per share. Again, this is not the real market price after we issue the rights. The market will react on its own ways with its own mechanism. The market is the composition of too many investors, and sometimes their decisions are not only rational based, but maybe irrational, maybe the representation of their expectations. So the market price can be 3, can be 4, can be $5 per share. The theoretical X rights issue price is the correct price that it should be in the market. If the market would have been a very efficient place of showing all the information and no information asymmetry existed. Okay? Any questions so far? Are you tired? Following? Please, any question? So far, did you understand how to calculate the multiplying factor and the theoretical X rights issue price? They may seem like not very easy concepts, and I agree, they have very long names in the formulas, but if you follow logically the flow of needs, how to calculate each component, I'm pretty sure it is not difficult. I hope you are still there. Are you still listening to me? Okay. Maybe you don't have question. If in case you don't have any questions, so I'm continuing. Okay. So it seems like we have the theoretical X rights issue price calculated in the way that the standard requires that. And right now I am able to calculate the multiplying factor. Okay. Why? Because right now I have all the information I need. The price of share prior to the issue is 3, and the theoretical X price is 2.5. Always expect to find a theoretical X price which is actually lower than the price of share prior to the issue. Why? Because with the issue of rights, we actually are not receiving as much resources as we need or we expect to have. And that is why the multiplying factor will be always or almost always greater than 1. So keep this in mind. The multiplying factor right now is 3 to 2.5. And with this in mind, we start with the calculations of earnings per share for 2018, and then to restate the amount of earnings per share for 2017. After this, pretty much the way of performing the calculations will be almost the same as in the previous case with the bonus issue. So we start with basic earning per share for 2018. In order to be able to calculate the basic earning per share, as we said, we will need two detailed information. The first one is the earnings in 2018, and the second information is the weighted average number of shares in 2018. Okay, so what do we have from this data that is required? The earnings in 2018 is over here, 550,000. It's easily available. I just put that in the right place to make the calculations regarding divided two. So again, this will be divided equals. Again, we need to calculate the weighted average number of shares. Try to focus how we make the calculation, even though it should be fairly easy right now. We start with 800,000 shares. They have been outstanding, remember, for 6 months out of 12 months. And remember that they have to be also weighted with a multiplying factor, 3 divided to 2.5. Okay, this is one component of the weighted average number of shares, plus we have 1,200,000 shares that are outstanding for the rest of the year, 6 months out of 12 months of the year. So if we make the calculations of the number of shares right now, we will find that the weighted average number of shares is 1,880,000. Okay, any questions so far? Any questions? I hope it is clear. Again, that means that the basic earning per share for 2018 is going to be simply the ratio between two amounts divided with, okay, and this is the value of the basic earning per share for 2018. I'm putting in brackets the representation in monetary value, 50.9 cents per share in 2018. So again, let's have this in the form of a simple table to represent all the necessary calculations. Okay, this is the first requirement. The second requirement is to restate basic earnings per share for 2017. In order to do that, we have to start with the reported basic earnings per share at the end of 2017. By the end of 2017, we still didn't know that we would be issuing some rights by mid of 2018. That would happen in the future. So by the end of 2017, I just know the amount of earnings, I know the weighted average number of shares of 2017 again, and that is basically very simple and clear information. So reported basic earnings per share in 2017, let's see how much or what is the figure that we get. The earnings of 2017 is over here. The amount of the weighted average number per shares is over here. We start and we end 2017 with basically the same amount of shares. That is that the reported basic earning per share for this year is simply the ratio between the earnings and the weighted average number of shares. That is that by the end of 2017, I'm probably reporting 57.5 cents per share, the amount of the basic earning per share by the end of this year. Okay, so let's have that restated. The restated basic earning per share for 2017 will be equal with the previously reported basic earning per share of 2017 multiplied by the inverse multiplying factor. that is restated basic earning per share for 2017 will be equal with 57.5 multiplied by 2.523. This is the inverse multiplying factor, and I've previously done the calculations. That would be equal to 47.9 cents per share. Okay, so this is how we do the calculations of the previously reported earning per share for the previous year, and then to restate by applying the inverse of the multiplication factor. Any question to that? Something that we need to clarify further? What do you think? So let me make a summarization of all what we said. In case we issue and write, we have to take into account the thing that the rights issue actually is not a full market price issue. That is, we don't collect as many resources as we should collect in normal condition. And that represents like a combination between a bonus and a full market price share issue. That means that the number of ordinary shares that we need to take into consideration to calculate the basic earning per share will take into account the time period very well, but will also take into account a multiplying factor or multiplication factor. This factor will help to achieve the requirement of IS 33. I will go to that, Elena, yes. Will help us, applying the multiplying factor, will help us to take back the transaction at the beginning of the current period, and applying the inverse of the multiplying factor will help us to restate the previous period figure. The multiplying factor in case of rights issue is not a ratio between number of shares, but is the ratio between prices of shares. The price prior to the issue to the price right or after the issue share, not actually the market price, but what we know as an assumed price, theoretical, after rights issue price, X rights issue price. This theoretical price is simply the ratio between the total value of the price of the share, and to the total number of shares. The total value is the market capitalization plus proceeds from issues divided by the new number of shares after the issue. These are the formulas. Let's apply them to our case. In our case, the theoretical rights issue price we calculated, and we found out it was 2.5. Multiplying factor is the the share price before the rights issue, $3, to the X theoretical price, 2.5. Okay, we have this. Let's go on with calculating basic earnings per share first in 2018. Pretty simple. We calculate the earnings are readily available. The weighted average number of shares, this is what deserves more explanations. Over here, we apply not only the time factor, but also, as you can see, it is important to apply the multiplying factor as well. Okay? 3 to 2.5. Okay. As you can see over here, I just wanted to put it in bigger letters like this. Okay, and we get this amount of the number of share, weighted average, and this amount of basic earnings per share. You see that what we used, the multiplying factor, was to correctly account for the period of the opening number of shares. Then we go to 2017. Simply, we can calculate the restated value of basic earning per share by multiplying the previously reported earnings per share at the end of 2017 with the inverse multiplying factor. Okay? So what we calculate over here is the reported basic earning per share. We calculate that as 57.5. And if we apply the inverse multiplying factor, that would give us an amount of 47.9 cents per share. I don't know if that is clear now I don't know who made the question. Elena, is that more clear now about the last results? If you want to know why do we do this calculation and why, thank you, why we apply the inverse, do not write down anything, but just to provide some more in-depth understanding of what's going on here. Now, what we basically do for 2017, and we could do that, is to, again, do not write anything, please. I'm just going to undo everything later. Maybe we can calculate the restated basic earnings per share by restating the amounts of both earnings and weighted average. So the earnings restated, no change in that, because nothing changes in the restated earnings of 2017, but the weighted average number of shares 2017 restated after the issue of the rights would be equal to 800,000 shares multiplied by the multiplying factor. So multiplied by 3 divided by 2.5. So in this case, you would have 800,000 multiplied by 3 divided by 2.5. So let's have it calculated in a different way. The restated number of shares, if I apply the multiplying factor directly to the number of shares to the previous year to restate them, it would be 960,000 restated shares. And if I calculate directly the amount of the basic earning per share of 2017, I would have, as you see, 47.9. So one way to do that is to see what you have reported for 2017 and multiply that by the inverse multiplying factor, or have it this way: restate both earnings and number of share for 2017. In this case, 2017, no change in restated earnings, but when you restate the number of shares by multiplying them with the multiplying factor, you will get the same result. So mathematically, it's basically the same thing. You can follow two approaches. When you already have the number of the amount of the basic earning per share of the previous year, do not lose any more time, just apply the inverse of multiplying factor as we taught you. In case you don't have that, you can follow the second way as well. You restate both components of the basic earning per share ratio, both the earnings and the number of shares. Did you get that, the second way? Maybe you can, maybe this can help you to further understand more in depth why do we perform the calculations this way. I hope that is clear for most of you. I'm just undoing everything because the idea was just to show why, but actually we will follow and require just to know the beginning formulas. The reported from the previous period multiplied by the inverse multiplying factor. Okay, so it seems like you don't have any more question. I think that before we make the break between two sessions of the lecture today, I think that we are ready to go in our last example. It will be fairly easier than these two, so no need to worry. Okay, so I'm opening the last illustration for today, and then we are going to have the break in between the sessions. Okay, thank you for your patience. The last example will be fairly shorter, so don't worry about that. It relates to calculating I think that you have in your screens right now, the data, the information. This last example relates to the calculation of diluted earnings per share. So this is not the case when I issue any rights or any bonus or stock dividends, but when since the beginning of the period, the company may have outstanding or in issue in circulation what we know as potentially ordinary shares. The potentially ordinary shares are securities that have potential dilutive effects. For example, preferred shares that can be converted into ordinary shares, or loan stock that can be converted into ordinary shares, or options that can be converted into ordinary shares. Whatever the case is, we have to calculate two amounts of earnings per share in these cases. The basic earning per share that takes into account only what we already have as ordinary shares, and the diluted earning per share, which takes into account also these potentially dilutive securities. Okay, so let's see what is the data, the information that we have here. For the year that ends in 31st of December 2009, Brightworm Utility Company had net income, be careful, not earnings available to shareholders, but net income, 1,750,000. The company had an average of 500,000 shares of common stock outstanding, and be careful, 20,000 convertible preferred shares. No other potentially dilutive securities. So no options, no loan stock, and so on. Now, regarding the preferred shares, each of them pays a dividend of $10 per share. Remember that the dividend of the preferred share can be expressed either as a percentage, as we saw a short example in class last week, or can be expressed in monetary value like this. So you can either have like 10% dividend, preferred dividend, or $10 per share. Both are exactly the same way. And each of these preferred share is convertible into 5 shares of the company's common stock. Calculate the company's basic and diluted earnings per share. Now, I'm following the same kind of calculations, or the same mini table used to properly show the calculations that we introduced in the previous examples. In the first row, I'm going to put the earnings available or attributable to common shareholders. Okay, so this is going to be the amount of the earnings that is available to common shareholders. And then I'm just leaving a row blank in case I need to put up some information there. And then we are going to put the amount of weighted, okay, weighted average number of shares. Now remember that the earnings available to common shareholders will be equal to net income less preferred dividend. Okay, so let's keep that in mind. That the net income of the company, if we remember, is 1,750,000 less what was equal to $10 per, let's check the data, that was $10 per share, and we have 20,000 preferred shares. That is 10 multiplied by 20,000. Okay, so we have the earnings available to common shareholders, 1,550,000. Again, it is equal to net income less preferred dividend. I'm putting in brackets also the calculations because you might need them. This is the dividend multiplied by the number of preferred shares. So this is the way how to calculate the earnings. Remember, if it says net income, you should pay attention if it is net income before or after the taxes, and then to subtract always the preferred dividend, not the common dividend, but the preferred dividend. The weighted average number of shares, in this case, we do not have any problem with the number of shares. The company had an average 500,000 shares and no problem with issuing bonus shares. So this is something that is directly provided as information for you over there. So again, the basic earning per share is the ratio between both. So we have, finally, the basic earning per share is equal to 3.1. Again, let's represent this in the form of a mini table. Let's say, okay, what about the diluted earnings per share? How we can calculate the diluted earnings per share? First, we start with earnings available to common shareholders. Earnings available to common shareholders. We previously calculated that this amount, the earnings that are available to common shareholders, we calculated them to be 1,550,000. And this is the amount that we are going also to have into consideration about the calculation of diluted earnings per share, because after converting the preferred shares to common shares, nothing changes in the amount of earnings that are available to our common shareholders. So earnings available to common shareholders, when we calculated the basic earnings per share, and when we calculate the diluted earnings per share, it's the common starting point is going to be the same. But we add back plus preferred dividends because they are not going to be distributed anymore in case we have the conversion, as we are saying, in case we have the conversion of the preferred shares into ordinary shares, then the earnings available to common shareholders after the conversion of preferred shares to common shares, we don't have to pay this amount of earnings, this amount of dividends anymore. That is, the earnings available to common shareholders will now be the sum of both. It will be 1,750,000. Again, in calculating diluted earnings per share, we start with adjusting the amount of the earnings. The earnings, in case I convert the preferred shares to common shares, the earnings will be higher because I do not have to distribute preferred dividend anymore. So earnings available to common shareholder after the conversion of preferred shares will actually be 1,750,000. But what about the amount of weighted average number of shares? Remember that in case we have the conversion that we are talking about, the weighted average number of shares, of course, it will be the previous number of shares, 500,000, plus the 20,000 new shares that I will have, after the conversion of the shares. So the new number of shares is going to be 600,000. Again, each preferred shares is convertible into 5 shares of the company's common stock. That is, I start with 500,000 ordinary shares, and the number of new shares that are going to be converted are 1 to 5. If we have 20,000 preferred shares, we'll have or will receive 100,000 common shares out of them. So the new number of weighted average number of shares is going to be 600,000. Therefore, we have the two components that we need to calculate the diluted earnings per share: the ratio between the earnings that after the conversion is available to common shareholders divided by the new number of weighted average shares, and that is that the earnings are new amount of earnings per share diluted after the conversion takes effect will be 2.92. So this is a way or a certain approach that we can take to calculate the diluted earnings per share. Any question to that? Of course, there are other potential dilutive securities like options or loan stock. In case you have the other examples, you will follow the same approach. You will recalculate the new amount of earnings after the conversion. In this case, what we change in the amount of earnings is that we add back the amount of preferred dividends, because in case of conversion, these preferred dividends will not be distributed anymore. And something else that I need to mention over here, preferred dividends are subtracted or deducted after the taxes and that is we do not have any tax effect over here. Okay? Then we recalculate the new number of shares after the conversion, and we should really be very consistent with following the rules over here. How does the conversion takes place? Usually the information in each exercise is very specific. We'll have this new amount of new shares for this amount of loan or preferred shares or options and so on. So again, this is divided and this is equals. This is the formula that we usually follow. Any questions so far? I'm waiting. If there are any questions, this is the very last thing that we are going to talk about, earnings per share. We'll have tutorials and we will come back to treat some examples, but in the tutorial classes, theoretically speaking, or putting down a template to have for further exercises, this is all. You are going to have these three exercises in Moodle, but for the moment, is there anything you want to ask or something not clear? Maybe you got tired and you are already having your break. I think that 10 to 15 minutes break is very deserved right now. In case you need to think over any question during the break and you need to ask me after the break, you are welcome to do that. I'm not interrupting the sharing of Excel. I'm just closing the audio and video until the finishing of the break, okay? So maybe we are ready to start again. What do you think? Maybe it was a short break and there were many things and details that we covered this morning. I really hope that was clear to you. We had one or two questions in the chat and I tried to answer to that, but in case any of you has any other questions regarding the calculations of earnings per share in case of issuing bonuses, rights, or diluted earnings per share, please let me know so we can go over that again. There is no need to hurry and jump to the next topic to discuss. In case you don't understand anything, we have plenty of time to cover for that. We have added an extra tutorial this afternoon, so we have time. Please let me know in case everything is clear with a yes or okay in the chat, so I can be really very feeling good to myself knowing that you have understood everything. Regarding or related to the earnings per share, remember that we are going to have a tutorial on Friday this week, and I'm going to post the questions regarding the tutorial on the earnings per share this afternoon, so you will have plenty of time to go through that. Also, regarding the question that I think Erica made in the chat, this afternoon I'm going to post in Moodle two guidances. The first one relates to the group work project. I think it will be a detailed guidance to really give you information on what topic to include in your presentation, how long it should be. There is no limit actually to that. You are required to present, each of you, so each member of the group will have 2 or 3 minutes to present. Overall, there will be 10 minutes timing for presenting for each group, plus 5 minutes time for questions from professors. And there is also a draft schedule for time slots for presentation for each group. So each of you knows when your turn is, so you can plan accordingly. Because I've had several requests from some of you to make a schedule time slot, and I prepared that. I hope that is fine. In case any of the members of any of the groups can't make it to the assigned or pre-drafted time slot, please let me know by email so we can work out a solution. Maybe you can talk to members of another group to have a swap with them. Maybe that would be like the best solution. But in case you cannot, please let me know so I can work out a solution over there and see what we can do, okay? Okay. So as we do not have any questions, I'm just stopping to share the Excel file right now. As I told you, this afternoon we're going to have a detailed guidance on work group projects uploaded on Moodle, and also some guidance on the final exam. You know that the final exam will be held through Moodle, so in an online environment, but you are required to go at SA and take the exam for that. But more details about that, I don't want to take more time right now. More details about that we're going to have this afternoon, okay? And then we can discuss about any unclear thing or something else that you might have. Okay, in this second session of today's lecture, we are going to talk about two other topics in the disclosures requirement. Again, we are at chapter 24 at our textbook. It is covering the disclosures requirement, and we started with the disclosure for earnings per share. As we mentioned, it should be included in the face of the income statement by the bottom line of the income statement, but it should also be supplied with detailed information in the notes to the financial statements. What about other requirements for disclosure? There are two very important ones that we need to explain. One relates to the segment reporting, and the other one relates to interim reporting. And both of them are going to be explained right now. I just wanted to mention something regarding the. Can you see right now on the screen the operating segments chapter? Something, it covers topic 24.2. Can you see that on the screen right now? Okay, thank you. Something that I need to mention in this moment is that both topics that we are going to cover at this part of the lecture, that is operating segments and interim reporting, They are going to be covered only theoretically in the exam. So there is no exercise or problem requiring you to solve anything that is going to be required related to these topics. You just need to know them theoretically, need to recognize the concepts, need to apply the concepts, but they are going to be tested through probably multiple choice questions or some theoretical question. No exercise, no problem related to this part of the lecture. Okay? So first, what are operating segments and why are they important to be able to understand and assess the performance of a company? A very strong emphasis has been put lately and recently to the operating segments, and this is quite a hot topic of discussion among investors, among preparers of financial statements, and also among academics as well. Why is that so? We are going to cover, first of all, the purpose of segmental reporting. Why was that included in the financial reporting in the first place? Why do companies need to report on their segments? And what are operating segments? What we can define by an operating segment. Is that a business segment? Is that a regional or geographic segment? Is that a product segment or something else? So the operating segment has a clear definition related to the standard that we need to clarify and explain. The other thing that we need to learn is about the criteria to determine what is a reportable segment. We may have thousands of operating segments, but they do not all fulfill the condition to be reported separately in the notes of financial statements. There are some thresholds that should be fulfilled or met in order for the segment to become reportable, to be required to be reported and disclosed separately in the financial statements. And we are going to cover that information in this part. Then at last we are going to cover and understand what are the entity-wide disclosures. Except for the segmental reporting that focuses on specific segments, what else should be disclosed or need to be disclosed regarding the entity level or the entity-wide disclosures? Sometimes they may be aggregate information regarding the same segments that we are reporting in segmental reporting, but other times that they are specific and other information as well. The contents of what we are going to explain, first of all, we are going to cover the aim and scope and purpose of IFRS 8. IFRS 8 currently covers the reporting and preparation and disclosure of the segmental reporting. So whenever we think about segment reporting, that is related to IFRS 8 in the IGAAP and financial reporting framework. Second, we are going to be very specific and very detailed about how to define a segment. There are many kind of definitions that may exist, but the standard actually has been very precise to select only one of them and to apply this definition to what we know today as operating segment. Then what is a reportable segment? What is the threshold or the criteria that should be met by a segment in order for that segment to be reportable separately and to be disclosed information in the notes of financial statements? Several information should be disclosed about the segments, covering the revenue, covering the expenditure, covering the investments, the activities, or the number of employees regarding to separate segment operating segments that are identified and that have made the criteria to be reportable. And we are going to mention the coverage of disclosures that should be included in segmental information. Then we are going to talk about measurement and reconciliation. The problem with segment reporting, it's not actually a problem, but requiring the IFRS 8 requires for the segments to follow a management point of view approach. That means that sometimes when we report data about segments, they are not following the IFRS rules. They are following the internal measurement and valuation basis applied by the management of the company, and that needs in the last moment to be reconciled with the data for the all entity that are being submitted and reported according to the IFRS. And this point of reconciliating the data is really very important because this increases the comparability of information between different companies. So, which is the objective of IFRS 8? What is the purpose and what is the meaning and the need that we have to apply on IFRS on standard only relating and only covering the preparation and disclosure of information about the segments, different segments? Usually, what we find in the financial statements as users is very aggregate information. So, what we see there as revenue or cost of sales or current assets or property, plant, and equipment, all these items that I am mentioning, all this information actually relates to the whole company. And the company, sometimes, especially when they are big corporation, multinational companies, they may represent various revenues and expenditure that relate to various products, to various business segments, to various countries where these big companies operate. For example, Carrefour, it operates all across the Europe, and the revenue that we find in the income statement relates to the revenue generated to all of these countries where Carrefour company is operating. So obviously, what we need as potential investors and users about the financial statements, we need some help to properly judge and assess the opportunities and the risks that are faced by an entity. What we need is the disclosure of more disaggregated information. So we need to know the revenues, where do they come from? Mainly from which product, mainly from which business unit, mainly from which country. And we also need to know the investments, where they have been invested, all this new machinery or new plants or new equipment that the company has purchased, where is it invested to? So this is what we need to know, and this is the objective of IFRS 8. This is why declaring and reporting information about segments became first required. So we need to know more disaggregated information. So we need to know which are the risks, the real risks that is facing a real company in real life. There are some key definitions in IFRS 8. First of all, it was decided by the board when they introduced this standard. They decided that the approach to identify and to report the segment, the approach would be based on an internal management perspective. That means that we will follow, or what we read about the segments in financial statements is the same definition that the company uses for its internal purposes. That is quite easy for a company from the side or from the perspective of the preparers of financial statements. That is something that helps them during their preparation process of financial statements, because they just have to report about their segments, the same things, the same information, the same disaggregation that they are currently using for their internal assessment and managerial and decision-making purposes. So it means less work to be done on behalf or from the companies. Segments are to be identified following a perspective, following a point of view that the management is currently pursuing. Now, this means that information that I will disclose in the segment information, that is revenues about the segment, the potential investments or the planned investment for the future, or the expenditure for each of the segment, they will be measured with the same internal valuation rules that are used for the preparation of the internal management reports. Now, look at this very carefully. This means that the segment information is not following IFRS, if you can get it. As far as the IFRS 8 requires companies to represent the segment information following internal valuation rules, This means that the information about segments is not IFRS based. Revenues and expenditure are not following the IFRS criteria of, for example, revenue recognition or expense matching criteria in accounting. So be careful when you read information about segments. They are following the definition and valuation and measurement rules that are internal and specific for a company, but not necessarily the IFRS rules that govern the revenue and expenditure for the whole company. That also explains the requirement for the reconciliation that we mentioned before. Right at the end of the period, the company must make a reconciliation between the figures and the amounts of segments and the amounts of the entity-wide disclosure. Another thing is that the line items that are reported in the segment information would be those items that usually are used to communicate to the chief operating decision maker. Now, this one is really important to understand. The CODM, the chief operating decision maker, is a certain function identified and really important under IFRS 8, but this does not mean that usually he will always be a specific organizational position in a company. The chief operating decision maker is not specifically one person that is really making decisions about operating segments in the company. It may be very well a managerial structure. It may be the board of directors itself. The chief operating decision maker, keep in mind, it's not necessarily a person keeping or occupying a certain position in the company. I should add some background information to that. IFRS 8 is introduced in Europe like in 2004, very well after the equivalent standard existing and circulating in the US. They have their own standards, their accounting board, FASB, they have their own accounting standards, and they were regulating operating segments way too before and earlier than Europe. So in the board of standards in Europe, they actually introduced the internal segment and operating reporting standard later, and they adopted the same approach almost and the same regulations that are in US as well. So regarding the segment reporting standard, both regulations in US and Europe, they are almost the same. We are almost converging into the same requirements over there. In US, they were recognizing the position of chief operating decision maker, and in the Europe and under IFRS 8, they took the same approach. But regarding that we have different structure of organizing companies, it doesn't necessarily mean that we will have this position in our organizational structure. So chief operating decision maker will be identified under IFRS 8. And this is something that the companies should disclose into their notes. What is that they consider the chief operating decision maker? First of all, why should we need to disclose segment information? That is something that I mentioned before. As we said, companies may engage in different activities in various products, sometimes in thousands of different products, thousands of different business segments, geographical regions, different sectors, different customer categories, and so on. And that is why it is necessary to understand how much the entity is dependent on a specific sector or from a specific customer, because this helps the users of financial information to assess the risk of the company, if you may understand. So again, I need to know how much the company is exposed to a certain client or to a certain region in order to be able to assess the possible risk the company is undertaking. For example, if we are exposed or if the majority of our revenue are from one specific client, or from customers in one specific industry, if that industry happened to undergo a crisis, like we have an energy crisis right now, waiting to fully develop and unfold in Europe, if we are dependent on clients and customers that will have increase in prices due to energy crisis, that means that the risk the company is undertaking is a lot, is high. That is why we need to know the exposure or the dependency that we have as an entity, as a company, from specific clients or specific region, geographical region. The risk and volatility of each segment should be analyzed actually before investors make decision. This is something that we explain. Okay, the chief operation decision maker, that is a very specific position and definition that needs some further clarification. As the IFRS 8 states, the segment information should be reported employing a managerial perspective. That means that it should be the same information as the company itself is reporting to its chief operating decision maker. So the same information that is circulating within a company, and the company is reporting to its higher level of managerial structure, to a certain position or a certain structure that is known as chief operating decision maker, the same information should be reported in the financial statements and on its notes. Clarification, further annexes. Actually, remember that the chief operating decision maker, is not necessarily, as we said, a position or a person in the entity. This depends a lot on the different requirements of corporate governance, rules, and tradition that exist in different jurisdictions and different localities where the company really operates. For example, the chief operating decision maker can be the board of directors, because the board of directors is the one structure to whom the information on segments is directed and who take actually the decisions regarding the operating segments. Another possible chief operating decision maker can be the CEO itself, the chief executive officer. The chief executive officer is the one structure that can actually take the decisions and decide about the allocation of investments and allocation of expenditure among different segments. It may be the management committee or any other structure that is specific according to various corporate governance requirements in the different jurisdiction where the company is actually located. The chief operating decision maker, for example, in the US GAAP, is usually an individual. Very often it is the CEO or the president of the board of directors. So this is like a distinction. There are very few differences between segment reporting in US and under IFRS, but this one is one of them. So the chief operating decision maker, usually in US, represent an individual, a person, usually the CEO or the president of the board of directors. Whereas in Europe, the chief operating decision maker usually is not a person, but usually it's a structure, governmental structure. Management committee, the board of directors itself, and very seldom it can also be the CEO. What are the disclosure of segment information that are laid out in IFRS 8? For example, paragraph 5 says that an operating segment is a component of an entity that engages in business activities from which it may earn revenue and incur expenses, including revenues and expenses relating to transactions with other components of the same entity. Now remember that the business activities in which the segment is engaged can be internal business activities. It may not be necessarily a division that sells products to outside customers, but sometimes it can be an internal structure that really transfers from one division to the other the internal merchandise or the internal inventory. For example, if we have a division that buys and sells within the same company, it is considered also a segment under IFRS 8. So remember, sometimes you have outside transaction, that means revenues generated from selling to outside customers. But many times you will have internal transactions. One branch of the company selling to the other, one subsidiary selling to the parent company, and so on. These are also to be included in the definition of an operating segment, according to IFRS 8. Another feature is that operating results of the operating segment are regularly reviewed by the entity's chief operating decision maker, so that this person or this structure, CODM, could make decisions, very informed decisions about how to allocate the resources to the segment and how to assess the performance and also allocate bonuses or so on depending on the performance of various entities or various segments. So first, an operating segment is a component that engages in business activities. They generate revenue and recurring expenses, even though these revenues and expenses can be considered internal and not external to the market. And also, the operating results of these segments are regularly reviewed by the chief operating decision maker in order to assess the performance and in order to take decisions how to allocate the resources, how to allocate the potential investments to this potential segment that exist over there. Also, another criteria is that the operating segments have discrete financial information available. That means that the way you are collecting and analyzing accounting information through your accounting software makes it discrete and readily verifiable financial information available for each of the segments. The way you are collecting and analyzing and processing the accounting data allows it for you to make all these analyses regarding the revenue, regarding the expenditure, regarding the potential performance and profitability as well. Remember, an operating segment does not necessarily mean a business segment or a geographical segment. Actually, an operating segment can be either of them or none of them. It can be an operating segment, can very well be a certain division within a company that simply processes the inventory and sell to the production departments, for example. What are the different disclosure of segment information? A reportable segment is an operating segment for which segment information is required to be disclosed by the standard. Now, remember that we may have or we may identify different operating segments, but not all of them are required to be reported and disclosed in the financial statements. Actually, only segment data for those that are considered to be reportable segments have to be disclosed in the notes of the statement of financial position and statement of comprehensive income. Actually, this is an operating segment which meets certain threshold or size criteria, qualifies as a reportable segment. And these thresholds are really very specific. Let's see what we have in the chat first. Okay, we have a question. I have a question from one of your friends in the chat, and he's asking how these internal transactions coming from operating segments differ from related party transactions. Okay, the internal transactions can very well be transactions between several branches or several subsidiaries with each other. You have seen even before various examples when a subsidiary sells inventory to another subsidiary of the same company. Well, in the consolidated financial statements, we omit or we net off this internal transaction between various branches or various subsidiaries. Right now, when we report the segments, we should not do the same. We have to report these internal transactions. Even though we compensate or we net them off for reasons of preparing consolidated financial statements, regarding the segment disclosure, we have to report them. So this may be an example related to that. Another example, except for the subsidiaries, could be, for example, inner transaction from one operating division to the other. For example, many manufacturing companies, they may have various 3, 4, or 5 production divisions, and they may have only one maintenance division. The tasks of the maintenance division is to maintain equipment or machinery for the production division. Now, the maintenance division charges some expenditure and recognizes as a revenue the services it is offering for the production division, the maintenance of the machinery and equipment and so on. Now, in the financial statements, the revenue, the so-called revenue generated from the maintenance division is not reported because it is an internal transaction, but the maintenance division itself is assessing its performance, whether it is successful or not, very well based on the services that it is offering to the production divisions. I don't know if that is more clear now to whoever asked in the chat or not. What I'm trying to say here is that usually in the financial statements, you will find consolidated information or information that happens between the entity, the company, and the outside customers and related parties. Whereas when you report segments, you will have the same approach as you are having through internal assessment of segments or divisions. And usually in many companies, we try to assess the performance of different divisions by looking at how they perform. For example, in various manufacturing companies, as we said, we have a service division whose task is to service and maintain the equipment and machinery of the plants and different factories. For internal purposes, I would assess the performance of the service and maintenance division by charging some revenue, let's say. Actually, these are not real revenue, I'm not selling anything, I'm just charging expenditure between various departments. So again, this is due to the approach that is undertaken under IFRS 8 in order to account also for internal transaction that may happen in a company. As I said, after identifying the operating segments, what is a segment that internally I need to collect information, I identify a specific identity or entity, I want to assess the performance of this specific division, this is considered an operating segment. Are they all reportable and disclosed in the financial statement? Not all of them. In order to disclose information about an operating segment, they should follow at least one of 3 criteria that we have over here. The individual, okay, operating segments might be, we have the criteria later, sorry, might be aggregated for reporting purposes, okay, and the aggregation of different segments with each other have to follow the rules of having, for example, similar or the same nature of products and services. You cannot combine under the same operating segment 2 different products that have different characteristics and different features and different risks associated to them. Also, they have to be followed by the same nature of production processes, the same rules and the same tasks, how to produce and manufacture different products. The type or class of customer for their products and services, usually we collect in the same business segment a similar or the same type or the same class of customers. We cannot combine in the same class or in the same category two different classes of customers or of clients. And also another element which is important to aggregate together or collect together one, two, or more segments under one reportable is the methods that we use to distribute their products or to offer the services to them. And if necessary and if applicable, we also add to the aggregation rules the very nature of the regulatory environment. For example, if we are operating in banking in different countries have different regulations about banks, so we have to take that into account. Or if we are talking about insurance company that have branches or segments in different regional geographical regions, or public utility company that offer public services or public public utility offering. Okay, so I think that I have included the test question over here. Right before going on with the thresholds to be completed or to be fulfilled in order to be considered a reportable segment, we have a test question under segment reporting of IFRS 8. Okay, the following statement is not true. We have to distinguish which one of the statement is not correct. The segments are required to prepare and report financial statements as separate entities. The segment information would be measured according to internal rules of the entity. This seems okay. The line items would be the same as those reported internally. That seems okay. Segments are identified following an internal management perspective rather than any GAAP or IFRS framework. Okay, that is also okay. This means that the first statement is wrong. The segments are not required to prepare and report financial statements as separate entities. I would rather disclose detailed information about segments, but this does not mean that each segment will report its own statement of financial position or statement of other comprehensive income. IFRS 8, so as a summary, IFRS 8 requires to disclose information, detailed data about the segments, but that does not mean that the segments themselves are required to prepare and report financial statements as if they are subsidiaries. Remember when you explained the consolidated financial information, you mentioned that subsidiaries should report their own financial statements that later are consolidated with the financial statements of the parent company. So segments are not the same as subsidiaries. Having answered that, well, let's continue with the second test question over here. The chief operating decision maker, remember we talked a lot about him or the position over there, the structure, as described in IFRS 8, is necessary to be correctly identified in order to proceed with correct definition of segments. That seems okay. Could be a managerial structure or position, or even an individual sometimes. That depends on different jurisdictional and local requirements where the company operates regarding the internal corporate governance roles. Already engages in revision of data and information, so that is a structure that already does this job. It's not a task that we are assigning to him only for the purpose of IFRS 8. Actually, this structure is currently undertaking this task. It is already doing this job, or all of the above. It seems to me, and probably you have the same opinion, that all the information A, B, and C are correct, and that means that alternative D, all of the above, is the correct answer to this question. So let's jump to one part which is very important in this lecture, and that is the thresholds or the criteria that an operating segment should fulfill in order to be qualified as a reportable one. Again, we identify different operating segments. These operating segments actually have their own activity, I'm not making up anything just for the sake of reporting the information, because I'm following an internal valuation rule and measurement and reporting and disclosure right here. But are they all reportable? Maybe some of the operating segments are too small. They are performing such a minor part of the activities of the company that it's not really necessary to report on that. And that is why the standard has set or has assigned some threshold or some criteria in order to be able to identify which of the operating segments are reportable. So if any of the following thresholds are completed, so only one of them, it's enough to identify a segment as having the requirement to disclose and report it separately in the notes. The first one is the reported revenue. If the revenue from the segment, and keep in mind here that the revenue includes both sales to the external customers and also inter-segment sales of or transfers. Remember what we explained a little bit before. These interdivisional, intersegmental sales or transfers are not reported in the face of financial statements because they are considered internal transactions that are netted off or are omitted following the IGAAP standards. But when we account for segment and we have to decide whether they are reportable or not, we have to take into account not only the sales to external customers, but also the sales intersegmental or between the divisions. So if the reported revenue of one segment is 10% or more of the combined revenue of all operating segments. So that means that I have to calculate the revenue from all of the segments, but be careful. This doesn't mean that this is the revenue in the entity level, because the revenue that the entity has disclosed in the income statement represent the revenue only to external customers. When I calculate the revenue from all operating segments, I include there the revenue to external customers and the revenue being generated or related to intersegmental and internal transfers and transactions. Okay, so we have the absolute amount of its reported profit or loss. This is another threshold that should be completed. The absolute amount of the reported profit or loss should be 10% or more of the greater in absolute amount of the combined reported profit of all operating segments that did not report a loss, or the combined reported loss of all operating segments that reported loss. Now remember, if we have some segments that are reporting a profit and other segments that are reporting a loss, all of them together will give me a net income which combines profits and losses from all of the segments. When I need to check for this threshold, what we do is that we separate in two groups. One group will represent the segments that generate a profit, and the other group will represent the segments that generate a loss. And when I compare the profit of a profit generating segment, I will compare with the total profit of those segments that are reporting a profit, not including there any segment that is reporting loss. So basically, I compare the profit of the segment to the total profit of the first group, that is, representing only those segments that generate and report profit. And I compare the loss of any report to the total losses of the second group, which is only those segments that are reporting a loss. So that is the second threshold, remember? Remember that in both threshold, revenue and the profit or loss, we are keeping into account also the intersegmental or interdivisional transaction within a certain company. Whereas when dealing with profit or loss, do not take into account the net income of the company, but actually the total profit of the segments that are restating profit, and the total loss of the segments that are stating or reporting a loss. The third threshold represents the assets or relates to the assets, and if the total assets of a certain segment are 10% or more of the combined assets of all operating assets. So remember, the three thresholds relates to revenue, profit, and the assets. These are the elements that we are trying to explain here. I think we have a question in the chat. I don't know if, yes, this is Claudio. I don't know if you were present in the lecture like 10 minutes ago. We had an example provided about the intersegmental transactions. The very first, most simplified example is the transaction that happened between subsidiaries, because you already are familiar with this kind of transaction, considering them in preparing the consolidated financial statements. You saw that the subsidiary transactions are netted off in order to prepare the consolidated financial statements. But when we consider the reporting of the segments, they are not going to be omitted or left aside. For example, one subsidiary sells to the other subsidiary some inventory, and that really happens in many companies where subsidiaries are special entities. They have to prepare special financial statements, and I only consolidate them with the parent financial statements in the end of the period, reporting period. This is one example. The transaction between different subsidiaries. Another example, which is also very common, and I explained that, is when different manufacturing companies, they have different plants, but they have one special division that undertakes the maintenance of machinery in different plants. Now, this division or this department that is or serves as a service department to different plants and factories, they are not selling anything in the market to outside or external customers, but they are offering services for the plants and factories. For the internal valuation purposes, the management charges the revenue and expenditure for this service department as though they are having real transaction in the market. They are not actually, they are just fixing the problems and repairing machineries for the plants. But in order for me, I'm the manager, I want to assess the performance of this division, which is the servicing division. What will I do? I will take into account its expenditure, and I will consider, they are not revenue actually, but I will consider as a revenue the value of the work that this business decision has performed for plants or factories. Again, this is not real revenue, but this is considered revenue in order for me to assess the performance of this division. So this is also a very common, thank you, this is also a very common example of intersegmental different transactions that may happen in a real company. Okay, so thresholds are three. Remember, revenue, profit, profit or loss, or assets. Again, when taking into account all of them, remember that we follow an internal valuation approach. That means that they are not necessarily the total revenue, the total profit, or the total assets of the company itself. For example, the total revenue will include not only the external customers' revenue, but also internal segmental revenue that we just explained. Or the profit or loss will be referred only to those segments or those transactions that are actually reporting a profit. And in the other group, I will consider those segments that are actually reporting a loss. And so is the matter with the assets as well. But still, we have another thing that we have to keep in mind. We identify the entities that should disclose information if any of the segments that we identify completes or fulfills one of the thresholds that we mentioned, being that revenue, profit, or the assets. Still, if the total external revenue reported by operating segments does not represent at least 75% of the entity's revenue, we should continue to identify additional operating segments to be reportable or to be disclosed as and reported. That means that even if you identify several segments that fulfill the thresholds that we mentioned, and if in total this reportable segment do not represent 75% of the total entity's revenue, I should continue with identifying more detailed information about further operating segments. What are the factors or what are the elements that we include in disclosure of segmental data? First of all, the factors that are used to identify the entity's reportable segment, including the basis of organization. So this is to be made known and to be made available to the outside users of financial statements. When I read the financial statement and the annual report, I need to know what factors have driven the company to identify and categorize the reportable segments. They should not be left in dark for me. They should be made available and disclosed for me to have an opinion about that. Another thing is the type of products and services for which each reportable segment derives its revenue. And as we said that various operating segments maybe are not related to specific products. Sometimes a reportable segment is related to selling or offering a specific product, but sometimes they are not. So we have to provide this information. For each of the reportable segments, where are we deriving our revenue? From which type of product or from which type of services that we offer? Other information that need to be disclosed with regard to each segment under IFRS 8 include the segment revenue, either being revenue generated from selling to external customers or revenue generated from selling to internal transactions within a company. Segment expenses, the same approach, expenses that relate to outside customers or expenses that relate to internal transactions within a company. The segment assets, there is no other thing to consider about the segment assets. They are almost the same as the assets that are identified and reported in the financial statements. The segment liabilities, this item is not compulsory. Which are the specific segment liabilities? Sometimes it's not easy to derive, or it's not easy to calculate, because I have liabilities in total towards third parties, or I might even have internal liabilities to other segments or to other divisions. As this is not very easy to identify, the IFRS 8 stresses that this is not a compulsory information. This is not mandatory. It will be reported in the financial statement only and only if it is already being provided also to the chief operating decision maker. You see the approach of IFRS 8 over here? The approach is not to put so much burden on the preparers of financial information, but to take whatever that they are already preparing and providing as information to the internal structure that make decision about the segments, like for example, chief operating decision maker, whatever is being used for them as information, that is also going to be reported. Okay, so remember this approach, that is always really very important. Okay, now we have another test question. This one relates to the thresholds. And the question is, the threshold of 10% in identifying the reportable segment relates to at least one of the following. Okay, first one, total assets, total liabilities. I don't think we mentioned total liabilities, right? Remember that the thresholds related to revenue, profit, assets. So A is not correct. Alternative B, total equity, it's not correct. Alternative C, total revenue, yes. Alternative D, again, not correct because total number of employees is not mentioned as a threshold in the IFRS 8. So again, the threshold of 10% relates to revenue, either revenue or profit or assets. No liability, no equity, no number of employees. Usually assets, liabilities, equity, and also number of employees are usually used as threshold to categorize companies in big companies or small, medium enterprises or micro entities, but not for the reportable segment. So be aware, be careful with that. Another test question over here. I think we are by the end of the presentation for this chapter. Under requirements of IFRS 8 for reportable segments, which of the following is true? Usually this requires some minutes or moments to focus and to identify which one is true. I'm waiting for any suggestion from you in the chat. So only 10 or 15 seconds. D, we have D, okay. It's not difficult, I think. Okay, so obviously it's alternative D. The other ones, B and C, are obviously not correct because they are 80 and 95%, nothing to do with this percentage. And A is not correct because even though it says 75%, it is mentioning the total entity's income, and income is the net income, it is the profit, whereas specifically IFRS 8 mentions total entities revenue. So it's D, very good. Okay, a couple of seconds also for this question. Okay. It should be again very easy because I just mentioned and reminded you of the three thresholds. Okay, so it's alternative A. Remember, always revenue. Okay, revenue, expenses, and assets. Liabilities are not mandatory unless you are already reporting them to the chief operating decision makers. Number of employees, no, and equity, no. Okay. Some more information over here about the disclosure of segment information. So actually what we need to put in the financial statements as information about our reportable segments. What do we need to disclose? What do we need to show? First of all, we need to disclose the revenues that we are generating to external customers. These revenues are generated related to external customers, and they should be reported over here. The revenues from transactions with other operating segments of the same entity. These are the internal transactions that we mentioned a couple of moments ago. The interest revenue, it's important to know the revenue that is generated from interest in case any of the segment has made any investment in deposits or buying some securities in the market and they are generating interest income, interest revenue. Let's put that there as another important information that needs to be disclosed. Also, we have another piece of information, interest expenditure. In case the segment has actually provided a loan or is provided with a debt specifically for its own purposes, and we can connect the interest expenditure to the specific loan for the needs of this specific operating segment, it should be disclosed there. Depreciation and amortization, also this information relates to specific segments because they all have machineries and plants and equipment that we depreciate in a consistent manner, and we have to disclose this information about each of our segments. Other information, material items that will be disclosed and provided in accordance with IS 1. Paragraph 86 in IS 1, presentation of financial statements, requires that if any information related to income or expenses is considered material, and what is considered material is any piece of information the omission of which will impact the decision maker of probable future investors. If that is omitted, that would impact the overall assessment of performance of the company. So if you are including some material items, according to IS1, you have to do the same with the operating assets. The entity interest in profit or loss of associates and joint ventures accounted for by the equity method. Again, if you are disclosing that on an entity-wide approach, you have to apply that to also your specific entities. Any income tax expenses or income that you may have. Material non-cash items other than depreciation or amortization. For example, any amortization of any grant or other thing that you have received for your government and you amortize that over the year and for investments, you have to show that over here if that is material. Other things connected to the disclosure of segment information. Always the criteria that we need to use is the following of internal valuation rule. If this information is provided already to the chief operating decision maker, it should be also included in the disclosures of financial statements. But be careful, only if it is already provided for the CODM. The amount of investments in associate and joint ventures accounted for by the equity method. If we are providing this information for our chief operating decision maker, we should also include that in the disclosure and notes of the financial statements. The total expenditures for additions to non-current assets other than financial instruments, for example, deferred tax assets, post-employment benefits, and insurance contracts that we mentioned. If we are doing this disaggregation of information for each segment, and we are already providing this disaggregated information to our chief operating decision maker, we should put that also into our notes, disclosing about segment information. Remember, the last thing is to put the reconciliations back there. Why is that needed? Remember that when we disclose segment information, this is an information not following the IFRS rules, because it is following the management perspective or the management view. This is basically the same kind of information that I'm processing internally to provide to my upper management or top management structure. Basically, what we recognize here as the chief operating decision maker. That means that most oftenly than not, you will see that the total information about segments will not be the same as the information on the entity basis. For example, the total amount of income or revenue from the segments reported are not equal to the total revenue or the total income of the company itself. The management view perspective, the difference between IGAAP and non-IGAAP, and so on. Therefore, we have to provide, and we are supposed to find in the financial statements, the reconciliation between the total of reportable segments revenue to entities revenue, the total of reportable measures of profit and loss to the total profit or loss of the entity, the total of the reportable segment assets to the entity's assets, so again, revenue, profit, assets, the three thresholds, famous ones, and the total of reportable segments amounts of every other material item of information disclosed to the corresponding amount for the entity. Of course, in the last level of disclosures, we find what we know as entity-wide disclosure. They are not connected to the segmental data, but they are beyond to the requirement to disclose segmental information. And each company may choose whether to provide or to disclose entity data or not. Even if the entity has only one reportable segment, it should still disclose entity-wide information. So even if the company says that, okay, I do not have more than one segment, so basically all my information that I'm providing is linked to my only one segment identifiable, they still have to provide some entity-wide disclosures. Now, what are these entity-wide disclosures? First, information about products and services. That is, revenues from external customers for each product and service or each group of similar products or services. Whatever is your approach to identify the segments, they may be, for example, regional segments, segment in Europe, segment in US, segment in Eurasia, and so on. Even though you follow that approach to identify the operating segments, when you disclose the entity-wide information, you should give information about the different products or different services that you are offering. And more often than not, you will find in the financial statements of companies disclose the amount of revenue that they are generating from specific products. And sometimes that usually pinpoint and put into emphasis the products that they have newly introduced in the market. So it is important to have this information in order to judge and in order to assess the performance of the companies. Another information included in the entity-wide disclosures is the information about geographical areas. So what are the revenues from external customers in different areas of the globe? In Europe, as I mentioned, in America, Australia, and so on. This is important to understand the risks that sometimes are related to the developments in economic and political movements in different areas of the world. For example, problems that may arise in Asian countries, they may affect the flow of revenue from this specific geographic sector. And I need to have some information about the revenue from different or various geographical regions in order to assess the risk and dependency on certain regions. And also non-current assets that no other than financial instruments, for example, deferred tax assets located in the entity's country, and so on. So this information about geographical areas are important to assess the ongoing activity and performance of the company. Information about major customers, usually if revenues from transactions with a single external customer amount to 10% or more, the entity should disclose this fact because this means that we are very dependable on this certain customer. In case this certain customer has financial difficulties or goes bankrupt, their financial problems will be transferred to our company because of financial uh, impossibility to settle the debts or to settle the invoices we might have with them. Also, for the purpose of IFRS 8, a group of entities known to a reporting entity to be under common control shall be considered a single customer, and the national government, a local government, or a foreign government, each shall be considered a single one. In the last slide, I have actually included the illustrated example of disclosure of segment information that you already have also in your textbook. So maybe that is too simple to go through that. We have the management of a major multinational companies. They have identified segments from A to H, A, B, C, D through H, segment H over here. For each of the segment, they have reported the total segment revenues and also the inter-segment revenues that are generated through transaction with each other between different segments themselves. Here we have the segment result, either a profit with a plus or a loss with a minus. And in the last column, we have identifiable segment assets. We have to identify which of the segment is reportable, applying the thresholds. Now over here, we remind you of the threshold applied. We have the threshold related to segment revenue. Remember, we are going to take into consideration the revenue, not only external, but also internal, intersegmental revenue. Then we see the segment result. Be careful, we consider here only the profits separately and the losses separately. Identifiable segment assets on the last column, and then if it is only one yes, then we will say that that is a reportable segment. We see that all of them are reportable except for segment B. Segment B has no answers to all the three thresholds, so it has segment revenue less than the threshold, segment profit less than the threshold, and identifiable segment asset less than the threshold, and so on. The same with segment E. Of course, we have to check if the reportable segment account to more than 75% of the total revenue of all company. So what we do is that we add together the total revenue of the reportable segment, and we find out that that is 3,850, whereas the threshold should be 75% of the external revenue. Remember, not total revenue, including the intersegmental revenue, but only the 75% of external revenue. And that is the threshold is 3,394. As the reportable segment total revenue is higher than the threshold, this means that we should not continue identifying further operating assets to be disclosed. If the total revenue over here was lower than the threshold, we would continue to include either segment B or segment E that we previously mentioned are not reportable. We would include even them to reporting requirements over here. Basically, what you need to do for your group presentation, you will go to the disclosures of the segment information, including the identification of operating segments, reportable segments, chief operating decision maker measurement, and so on. You will have a special note, a special reference number, a special explanation in the notes of the annual reports covering the issues or topic related to the internal and the reportable segment information. Then you should prepare a short summary regarding this segment information. This summarized information should be the basis of you expressing your opinion, how you perceive this information is helping you to better analyze and understand the position of the company. So not only see what the company has reported, but also making like a summary and like an explanation how this information helped you to understand better the company. Sorry, I didn't get this question. Sorry, in the chat we have a question right now. Which page of textbook and which example was the previous slide? Okay, let me go back to that. I think that we are in chapter 14. Sorry, we are in chapter 24. And the topic that we are discussing, the topic of the segment reporting is 24.2. And the activity or the example is 24.2. If you want me to check in the textbook, thank you, Valentina, you did that for me. I would need to open my textbook right now. Okay, thank you very much. It's page 585. But the number of activity over here that you see in each example that I take from the textbook, I keep the number of activity. That number of activity would guide you through the examples provided within the textbook. Okay, so thank you very much about that. We are done actually with this. Why do we consider segment H? Okay, now you see that segment H is considered because it is a yes to the first threshold. So in case you meet only one of the thresholds, you should report that segment. It's not that you need to fulfill the 3 thresholds or 2 of them. In case you fulfill only one of the thresholds, you have to report the segment. Remember? So keep in mind, okay? Only the completion or the meeting only one of the criteria is enough for you to consider that segment reportable. So only one yes there, it's enough. Okay? 2 yes, it's better. 3 yes is definitely yes. If you have 3 no's, it's no, not reportable. But if you only have 1 yes, it should be reported. Okay? I think we got that. Thank you very much for sometimes answering or questioning. That is really important. So right now we have some more minutes left. This last chapter, it's also a topic, a specific topic in chapter 24, and it's really very short. I think that you will have 10 minutes to really understand and go through this last chapter that we are having here. It is the interim reporting. Again, it's part of chapter 24. Actually, it's topic 24.5, but it relates to a certain specific standard, and that's why it represents a specific chapter in our lectures. It's ES 34, interim reporting. By the name itself, it covers the rules of reporting interim results and interim financial statements. Interim financial statements are financial statements that are not reported at the end of the year, so after 31st of December, but are interim financial statements reported either each of 3 months or biannually or quarterly. So there may be specific time frames when we need to report interim information. So which are the main topics of interim financial reporting under IS 34? We have to know and understand the format of interim reports. Do they follow the full formats of financial statements, annual financial statements, or do they have different requirements? We need to know the notes of the interim reports and be aware of the valuation rules of this report that sometimes may be different from the valuation rules of annual complete financial statements. We will present that there are two methods or two approaches of preparing interim financial statements. Interim financial reporting and all the standards and requirements related to this reporting. The format that we usually follow when preparing interim reports and the notes to these reports. So first of all, what are, you cannot, none of you? Oh, okay, sorry. I think I was sharing my... Okay, sorry about that. And thank you for reminding me in time. I don't know what happened. Now let me... Okay. Is it better now? Can you see the slides now? Okay, sorry about that. So we are talking about interim financial reporting. We said that it is the topic 24.5 at the chapter 24. We are still in the same chapter. But this represents a special topic for us because this is a new standard. It's IS 34. So what are interim financial statements? These are statements that are prepared not on an annual basis, but probably every quarter or biannually. And sometimes we need to know how and what to do to prepare these financial statements. After all, why do we need to prepare interim reports? Why are they needed in the first place? Sometimes in order to be more informative and to provide more information about the company. It's not good to wait until the end of the financial year. So 1 January from 31st of December, it's very far away from each other, and sometimes companies do not wait a full year until disclosing some information about their activity. What they do is that once they complete the first quarter, they publish some interim financial report. And once they complete the first half of the year, they may publish a biannually interim financial report as well. So companies publish various interim reports throughout the accounting year until it is completed, and they prepare the full financial statements for the full accounting year and declare and prepare them. So how can I prepare interim financial reports? Basically, we may follow two theoretical approaches that are recognized and also advised by IS 34. The first one is the integral approach. This one considers the interim report, so that we prepare each quarter or each 6 months. They consider this interim report as part of the yearly financial report. This means that in order to prepare the interim reports for each quarter, we should first determine the yearly totals and subsequently allocate this over the different interim periods. That means that under the integral approach, depreciation I'm writing in the chat, equal to yearly depreciation divided by 4. For example, if I'm preparing the quarterly interim reports and I need to calculate the depreciation charge, Under the integral approach, this means that I will first calculate the depreciation for the year, and then I will divide it by 4 because there are 4 quarters in 1 year. Basically, this is not very practical, as you can understand. This means that in case to prepare the interim financial statements, I should follow an integral approach thinking for the whole accounting year before me. That's not very practical. And this is why the ISB, the board, has opted and really advises for the use of the discrete approach. Now, under this approach, we consider the interim report as being independent of the 12-month financial accounts, and we recognize assets, liabilities, expenses, and revenue in the period in which they occur. This means more work for us because we have to apply the standards that relate to the revenue recognition, expense matching, and so on. We should apply them more oftenly. We should calculate for example, the depreciation not on a yearly basis, but on a quarterly basis. Even in the straight line depreciation, that would mean more calculations. But still, this is the approach that is being encouraged to be used by the board. The format of the interim report, there are two options. You can either prepare the complete set of financial statements, and in this case, you will follow the format of financial statements that are advised under IS1, or you can follow a set of condensed or summarized financial statements that are provided under IS34, the standard that we are explaining. Remember that an interim period is a financial reporting period that is shorter than a full financial year. The minimum components and items that we need to show in the condensed financial statements are a summarized statement of financial position, a summarized statement of comprehensive income, a summarized statement of changes in equity, and a summarized cash flow statement. That is the 4 important mandatory required financial statements, but in a condensed format, in a summarized format, not with every line item that are usually reported on a yearly basis. And of course, they should be supplemented by some selected notes, explanatory notes. The paragraph 16 of the standard states that information that needs to be disclosed as a minimum. It is a statement that the same accounting policies and method are followed for interim reports as those for the full year reporting. Explanatory comments regarding a very sensitive issue, and that is the seasonality or cyclicality of interim operations. The difficulty arises in those situations when the company is characterized by cyclical activity. For example, companies, I'm just assuming, a company that sells candies or merchandise related to the Halloween party is a company that operates usually only during September and October. So they are characterized by a cyclical activity, cyclical revenue. The majority of revenue and expenditure will be during October and September. But investment production will be continuing all the year long. So how have we treated the cyclicality features in our interim report? That should be explained very in detail in the comments in the financial statements. And also the nature and amount of items that usually affect the assets liabilities, that is the item of financial statements. The nature and the amount of changes in estimates. If we have a change in estimates, for example, the useful life of the assets, if there is a change in that, we need to include that in the explanations. Whether we have issued, repurchased, or repaid debt or equity securities, ordinary shares, preferred shares, treasury shares, and so on. Even we have paid dividends separately for ordinary shares and other shares that could be preferred shares. Also, something else to disclose is that the segment revenue and segment result for business segments complying with IFRS 8 that we just introduced. If we disclose segmental information in the full financial statement, we should do the same in interim reporting to disclose this segment data. Material events that are subsequent to the end of the interim period. That is, important events that may affect the amount, very important amount in the items of the financial statements, even if they have happened after 31st of December, they have to be included in the notes of financial statements. Another thing to disclose is the effects of changes in the composition of the entity during the interim period. For example, if we purchase another subsidiary or if we dispose of an existing subsidiary, that is, the structure of the combination of the entity has changed, has been altered during the period. In the case of business combinations, the entity should disclose the information that is related to the IFRS 3 business combinations as well. So basically, these are the same data or the same information that you also disclose in the full financial statements. The only difference here being that you should really be careful what to consider as part of the period for which you are preparing the interim reports themselves. The valuation that should be used for interim reports are the same accounting rules and accounting policies that are applied in preparing the annual financial statements. Usually what we should look very carefully for and should really check if it is completed or not is that seasonal or cyclical revenue should not be anticipated. So they should not be recognized before the time they really happen and should not be deferred. So they should not be recognized later than the period in which they really happened. Okay, let's have some test question at the end and we are done also with this chapter. Which of the above is not an approach designated? The discrete is one approach. The modular approach is one. Sorry. I was just, yes. The discrete approach, the modular and the integral. The discrete approach is not, the modular approach, my mistake, is not an approach designated by the IS 34. We have two approaches, discrete and integral. Discrete is one that considers a separate treatment of each of the interim periods that are reported, and integral is the one not opted to use by the board, the one that looks at the overall year and divides that into different periods. So modular approach is not an approach designated by the IS 34. Okay, another test question. IS 34 permits two options for the presentation. So, okay, either a complete set or a set of condensed financial statements. Okay, this is the exact correct answer. We took that since the beginning. So A is the correct one. Either a complete set of financial statements, in this case we have to abide by this one, or a set of condensed financial statements, and that is when we abide to IS 34. Okay, for the group presentations, look on the company website. Usually you will find the interim reports, not in the annual reports, not in the financial statements. Go to the company website and look there for interim reporting. Usually they disclose that under the category or the menu for investors, financial information, you will find them in their interim reports as well. So you can have a look at the interim reporting and put some information in the group presentations, okay? Okay, so well done. We arrived at the end of the lecture today, and let's see, we have a question. Just a moment. Yes, Maria, I will do that. I will actually do that tomorrow, if that is okay with you, because today we have also lecture, tutorial session in the afternoon, and then I have to upload the today's material. So I promise that tomorrow I will put a note down, check or on the to-do list for myself. Tomorrow I will upload the previous exams. Okay, so don't worry about that. See you in 2 hours. In the afternoon, remember that we have to go through the cash flow statement exercises again. We have two examples, two exercises that we didn't quite explain in the last tutorial hours on Thursday. So we have to go through them today afternoon, okay? So thank you for your attention and see you later. Bye.